The sovereign squeeze, the silent war. Before we dismantle the casino, before we expose the mechanics of the paper rig, we must first understand who is sitting at the other side of the table. In part 1, we told you that industry is running out of silver. That is true. But there is a much bigger, much more terrifying player entering the game. A player that doesn't care about solar panels or electric cars. A player that cares about dominance. We are witnessing the beginning of a sovereign squeeze. For the last 50 years, the price of silver has been set in two places, London and New York. The West controlled the price. The West controlled the vaults. The West controlled the world. But in 2024, a new signal appeared on the radar. A signal that the mainstream financial press, Bloomberg, CNBC, The Wall Street Journal, refuses to cover. The signal is coming from Shanghai. While the spot price in New York was sitting at $28 or $30, the price for physical silver on the Shanghai Gold Exchange was trading for 10 to 15% higher. This is called the arbitrage of the century. And it created a vacuum effect. Giant 1,000-ounce industrial bars were being pulled out of the vaults in London and New York, loaded onto armored transports, and flown directly to China. Why? Because China is not playing a trade. China is playing checkmate. We know that the BRICS nations, Brazil, Russia, India, China, South Africa, are actively building an alternative to the US dollar. They know that the US dollar is backed by debt. They know that to destroy the dollar's hegemony, they need a currency backed by real assets. Gold is the shield, but silver is the sword. They know what we know. You cannot build a modern military, a modern grid, or a modern economy without silver. By draining the West of physical silver, they are not just making an investment. They are seizing the strategic supply lines of the future. This is why we are seeing the drain. But here is the twist. The one detail that turns this conspiracy into a financial thriller. Who is the biggest holder of physical silver in the West? If you listen to the internet forums, they will tell you it's the apes, the retail investors. But the data tells a darker story. The entity with the largest stockpile of physical silver in the world is likely the very same entity that has been suppressing the price for decades, JP Morgan. This is the ultimate double cross. For years, the bank has used paper contracts to slam the price down, the TAMP. This demoralized the miners. It banked the fires of inflation. It kept the dollar looking strong. But while they were selling paper to the public, they were quietly, methodically accumulating the physical metal at dirt-cheap prices. They were using their own manipulation to buy the dip that they created. Some analysts believe JP Morgan has amassed a hoard of nearly 1 billion ounces of physical silver. Why would they do that? Because they know the paper game has an expiration date. They know the BRICS are coming. They know the solar shortage is real. They are positioning themselves to be the kings of the reset. When the music stops, when the vaults in London are finally declared empty, when the force majeure letters go out, JP Morgan doesn't want to be short. They want to be the ones holding the only supply left for sale. They are preparing for a revaluation event, a moment where the price of silver isn't discovered by a computer algorithm, but by a desperate government needing metal for missiles and microchips. In that moment, the price doesn't go to $50. It doesn't go to $100. It goes to unobtainium. We are seeing signs that the window for the little guy to enter this market is closing. There are rumors, whispers in the dealer networks, that major banks are quietly making it harder and harder to withdraw physical metal. They are adding delays. They are increasing premiums. They are closing branches. The war and mystery of this market is that the exits are being sealed off before the public even smells the smoke. The $100 silver window is closing, not because the price is too high, but because the metal will simply not be for sale to you. The banks are banned from telling you this. The government is terrified of you knowing this. So how do we know when the trap will spring? We have to look at the mechanism they use to keep the illusion alive. We have to look at the casino.
In part 1, we exposed the crime. We watched 37.6 million ounces of physical silver vanish from global vaults in just 47 days. We proved the industrial world is running out of metal. But that leaves one burning question. If the world is running out, why is the price still sitting at $58? It sounds high compared to last year, but mathematically, it is nothing. The answer is the greatest magic trick in financial history. For every 1 ounce of physical silver that sits in a vault, the financial system has created up to 400 paper claims to that same ounce. They're selling the same house to 400 different families. This system works fine as long as nobody asks for the keys. But what happens when 400 people show up at the front door at the exact same time? Welcome back to the Macro Edit. In part 2 of this documentary series, we expose the casino. We are going to dismantle the mechanism banks use to rig prices and hide the shortage. We will uncover the force majeure trap waiting to confiscate your wealth. And most importantly, I will hand you the exit strategy. We will cover exactly what to buy, how to hold it, and the specific magic number that tells us when to sell. The paper market is about to break. Let's find out how to survive the crash. To understand the rig, you must distinguish between the price and the value. The spot price you see on your phone is not set by supply and demand for physical metal. It is set by traders exchanging futures contracts in New York and London. These are not receipts. These are bets. Imagine an airline with 100 seats on a plane, but they sell 4,000 tickets. They assume almost everyone will cancel or take a cash refund. They bet that only 100 people will actually show up to fly. This is called fractional reserve banking, and it is exactly how the silver market operates. The bullion banks, giants like JP Morgan and HSBC, act as the caretakers. They hold the physical metal, but they also trade the paper contracts. When the price rises too high, when it threatens the stability of the dollar, they can print billions of dollars in paper silver out of thin air and dump it onto the market. They flood the exchange with supply that does not exist. This crashes the price. The gamblers panic and sell. The banks buy back their positions at a profit, and the physical shortage remains hidden. They have done this for decades. They call it tamping, but there is a fatal flaw in their machine. The machine only works if investors are willing to accept cash instead of metal. And that brings us to the smoking gun, the registered collapse. In the massive New York vaults, silver falls into 2 categories. First, there is eligible. This is silver that is simply stored there. It is owned by private people. It is not for sale. Second, there is registered. This is the silver actually available to be bought and delivered. This is the dealer inventory. The registered inventory has plummeted from over 150 million ounces just a few years ago to barely 43 million ounces today. 43 million ounces. At $58 an ounce, that is roughly $2.5 billion worth of metal. That sounds like a lot, until you realize Elon Musk bought Twitter for $44 billion. A single billionaire could buy every ounce of silver for sale in New York, with the change in his couch cushions. That is how small this market has become. We are operating at a leverage ratio of nearly 400 to 1 on some exchanges. If even 1% of the people holding paper contracts ask for the real metal, the vault hits zero. And when the vault hits zero, the exchange triggers the trap. Skeptics argue the exchange will never let the price explode. They say the banks are too powerful, but we have proof they are wrong. We have the blueprint. Look back to March 2022, the LME nickel crisis. Nickel is a boring industrial metal, but in 2022, a Chinese tycoon nicknamed Big Shot placed a massive bet that the price would drop. Instead, the price went up. Fast. Big Shot got margin called. That means the bill came due immediately. He needed to buy billions of dollars of nickel to cover his bet. But there was no nickel to buy. The price went vertical. It doubled. Then it doubled again. In a matter of hours, nickel hit $100,000 a ton. The entire London Metal Exchange was technically broke. The banks were on the hook for billions in losses. The system had crashed. So, what did they do? Did they let the free market work? No. The exchange simply turned off the computers. They halted trading. And then, they did something unthinkable. They canceled the trades. They looked at the investors who had bought nickel at the right time, investors who made millions playing by the rules, and said, no, those trades never happened. They rewrote history to save the banks. This is the blueprint for silver. When a silver squeeze happens, do not expect the exchanges to play fair. When the price hits $100 or $200, they will change the rules. They will declare force majeure. This is a legal clause buried in the fine print. It effectively says, if we cannot deliver the metal due to unforeseen circumstances, we have the right to just give you cash. Imagine you bought silver at $30 to protect yourself from inflation. The price goes to $500. You feel rich.
But then you get a letter from your broker. Sorry, we can't give you the silver. Here is your $30 back, plus a small fee. You get the paper money that is losing value. You miss the wealth transfer. This is why we have a golden rule at the Macro Edit. If you can't hold it, you don't own it. So, how do we position ourselves? How do we beat the casino? We must move into physical reality. But you have to be smart. Not all silver is created equal. There are 3 lanes of silver buying. You need to know which lane you are in. Lane 1, sovereign coins. These are minted by governments. The American Silver Eagle, the Canadian Maple Leaf, the British Britannia. These are the gold standard, recognized instantly globally. If you need to cross a border or buy food in a crisis, these are the easiest to use. The downside? They are expensive.
You might pay $75 for a coin when the market price is $58. That extra $17 is the cost of trust. Lane 2, generic rounds and bars. The industrial lane, made by private companies. They simply read 1 ounce .999 fine silver. These are cheaper. If you are purely betting on the price of silver rising, this is the best way. You get more ounces for your dollar. Lane 3, junk silver. My personal favorite for the endgame scenario. Before 1965, US dimes, quarters, and half dollars were made of 90% silver. Today, they're sold in bags. Why do you want these? Small change. If silver hits $300 an ounce, buying a loaf of bread with a 1 ounce bar becomes impossible. The shopkeeper can't make change. A silver dime would be worth roughly $20. It is the perfect currency for a world where paper money fails. The trap to avoid: numismatics. Do not buy graded coins. Do not buy rare collectibles. In a panic, nobody cares about rarity. They care about weight. You will pay double for a rare coin, and when you go to sell it, you will only get paid for the silver content. Stick to the weight. Ounces are all that matter. Now, we arrive at the most critical part of this documentary: the exit. Buying is easy. Selling is hard. Most gold bugs make a fatal mistake. They fall in love with the metal. They bury it in the backyard and vow never to sell. This is wrong. We are investors. We are here to grow our wealth. Silver is volatile. It shoots up like a rocket, and it crashes like a rock. If you ride it all the way up and all the way down, you have accomplished nothing. We need a signal. We need to know when the mania has peaked. This brings us to our ultimate indicator, the magic number. We use the gold to silver ratio. This simply measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is roughly 72 to 1. It takes 72 ounces of silver to get 1 ounce of gold. This is still historically cheap. In a bull market, silver price runs faster than gold price. That ratio gets smaller. In 2011, it hit 30. In 1980, it hit 17. Here's the plan. We wait. We hold our physical silver. We watch the price explode. We watch the headlines scream about shortages. When that ratio hits 40, we wake up. When the ratio hits 30, we execute the swap. We take our volatile, overvalued silver, and we trade it for gold. Or we trade it for land that pays us rent. Think about the math. If you have 1,000 ounces of silver today, you can trade it for almost 14 ounces of gold. If the ratio drops to 30, those same 1,000 ounces of silver will buy you 33 ounces of gold. You have more than doubled your gold holdings without spending a single extra dollar.
You used silver's wild price swings to slingshot yourself into the safety of gold. This is how the dynasties of Europe built their wealth. They didn't just hold, they traded the ratio. We are entering a period of history that looks like the 1970s on steroids. Governments are drowning in debt. They have 2 choices: default and admit they are broke, or print money and destroy the currency's value. They always choose to print. When they print, paper assets die, bonds die, savings accounts die, but hard assets wake up. Silver is the most undervalued hard asset on the planet. The 37.6 million ounce drain was the starting gun. The vaults are emptying, the miners are tapped out, and the paper claims are stacking up like dynamite. We are not just watching a price chart. We are watching the end of an era. Those who hold paper will be the creditors of a bankrupt system. Those who hold metal will be the owners of the new one.
The exit doors are still open, but they are closing fast. Don't be left holding the receipt. Hold the thing itself. This is the macro edit. Subscribe if you want to survive the edit.